Market efficiency. Can you really beat the pros? John sits in his command center, eyes glued to a wall of monitors displaying the real-time movement of global equity markets. He has spent the last few lessons learning how to navigate the psychological minefield of trading. He has conquered his anchoring bias, he has disciplined his FOMO, and he has learned to detach himself from the paralysis of loss aversion. Now, he faces the ultimate challenge. He wants to beat the market. He believes that with his custom-built algorithms, his understanding of economic indicators, and his ability to analyze corporate balance sheets, he can consistently find undervalued assets and generate returns that outperform the major indices. He is ready to join the ranks of the professional hedge fund managers who command billions of dollars. But before he executes his first major trade, he pauses to consider the most humbling theory in the entire field of finance: the efficient market hypothesis. As Brealey, Myers, and Marcus explain in their seminal work on corporate finance, the efficient market hypothesis, or EMH, is not just a theory. It is a challenge to every investor's ego. The core idea is that stock prices in an efficient market fully reflect all available information. This means that at any given moment, the price of a stock is the correct price, representing the market's best estimate of that company's future cash flows, discounted back to the present. If John thinks he has found a hidden gem that is trading below its true value, the market has likely already accounted for all the public information about that company. If the company were truly undervalued, other investors, thousands of them with faster computers and more capital than John, would have already bought it, driving the price up to its fair value. This leads to the concept of the random walk. If the market is truly efficient, stock prices should follow a random path. Because new information, such as a surprise earnings report, a change in government policy, or a technological breakthrough, is by definition unpredictable, the movement of stock prices must also be unpredictable. If John could predict tomorrow's price based on yesterday's price, then the market wouldn't be efficient. It would be a predictable system that arbitrageurs would have already exploited. The randomness of price movements is not a sign of chaos. It is a sign of efficiency. It means that the market is constantly incorporating new, unpredictable news into the price, leaving no room for John to outsmart the crowd using historical data alone. John feels a sting of disappointment. He wants to believe that his hard work and his stickman methodology grant him an edge. But the data from Brealey, Myers, and Marcus is stark. The vast majority of active portfolio managers, the highly paid professionals with teams of analysts, fail to consistently beat the market average over the long term. If the pros can't do it, what chance does John have? This is the paradox of active management. For an active trader to win, someone else must lose. Every time John buys a stock he thinks is undervalued, he is betting that the person selling it to him is wrong. But in an efficient market, the seller has access to the same information. If everyone is trying to beat the market, the aggregate of their efforts keeps the market efficient. John starts to rethink his entire strategy. If he cannot consistently beat the market, then trying to pick individual winning stocks is not just difficult. It is a distraction from what really matters. He realizes that beating the market is a game of luck, but participating in the market is a game of wealth. This is the argument for passive investing or index investing. Instead of trying to find the one winning keyboard manufacturer among thousands, John can buy the entire market through an index fund, a collection of stocks that tracks the performance of the economy as a whole. This strategy accepts that the market is efficient and that he cannot predict the future. It lowers his transaction costs, reduces his risk, and allows him to capture the long-term growth of the economy without the stress of constant trading. He looks at his terminal again. He sees the active strategy versus the passive strategy. The active strategy is thrilling, complex, and potentially ego-boosting, but it is statistically likely to underperform. The passive strategy is boring, simple, and statistically likely to build wealth over decades. John realizes that his neo-finance project doesn't have to be a speculative hedge fund. He can be a sophisticated investor by focusing on his own human capital, the skills he brings to the market, rather than trying to play the role of a Wall Street clairvoyant. He stops looking for the next big thing and starts looking for the consistent thing. As the trading day comes to a close, John turns off the monitors. He has come full circle. He started this journey thinking that finance was about outmaneuvering the market. He ends this section realizing that finance is about understanding the reality of the market. He understands that markets are efficient mechanisms for aggregating information. That price is a signal, and that his best bet is to align his strategy with the long-term growth of the economy rather than fighting against the tides of randomness. He is no longer a gambler hoping for a lucky break. He is a disciplined investor who respects the efficiency of the market. He has moved from the realm of getting rich to the realm of building wealth. John is ready to take the next step, to start applying these financial principles to his own business and his own life, building a structure that can survive the market's efficiency and thrive in its long-term trajectory. He is no longer just a stick man. He is an architect of his own financial destiny.